Hello and welcome to TMC Connect. Thanks so much for being here. I'm going to give everybody just about 30 seconds to come in and then we'll get started. Greg, I was going to ask you, is that a monitor behind you? That's a really great, I love the visual of your MGIC.
That is actually a picture in my office at home. I'm actually at the Vince Lombardi rest stop off the Jersey Turnpike right now, but it doesn't look that way.
Oh, sorry, I called you out. Fantastic. Hi, well, welcome to TMC Connect. My name is Tony Bramley, and I'm the Director of Business Development here at the Mortgage Collaborative. I have the great pleasure of working with CondoTek as well as MGIC, and think the most of both of those trusted partners here with the Mortgage Collaborative, and we are excited to have them here today. They're going to be talking about providing solutions for lenders to close loans quickly and compliantly. Just a couple of things to remember. This is a webinar, so you are on mute, but we want it to be interactive. So please drop your questions or your comments in the chat, and we will address those at the end of the presentation. There will be a follow-up email that'll come to you tomorrow. It'll have a link to the video because this is being recorded, as well as the deck will be included. If you have any questions, Greg and Orst's information will also be as part of that follow-up, so you can reach out to them directly. Once again, thank you so much for being here, and I am going to turn it over to Orst.
Thank you so much. I'm such a big fan of this organization and the Mortgage Collaborative, and I have to say, over the last several years, we've been so happy to be able to answer so many questions about condominium and cooperative lending throughout the United States to so many lenders. So we appreciate it very much. So without further ado, I'm Orest Tomaselli. I'm partner and president of the project review division at CondoTek, and I'll be providing you an outline today of these solutions for condominium developments on getting compliant with lending guidelines and these new guidelines that have come out from Freddie Mac recently. And I am so happy to have joining me Greg Korn from MGIC. So Greg, do you want to give your introduction as well?
Sure, thanks, Orest. I'm Greg Korn. I manage the northeastern area of the United States for MGIC, and Orest and I actually met doing a condo webinar for a state association a couple of years ago, and there are so many pain points for lenders with condominiums that we tried to provide solutions, and we just kept talking and talking, and actually we formed a partnership with CondoTek to help lenders with those solutions. And so when we had the opportunity to support the Mortgage Collaborative and all of their members today, we got together and said, this is a no-brainer. Let's go in and educate them. We'll talk about some of the pain points, how they can be solved, as well as provide you some relevant information about some of the rapidly changing guidelines when it comes to condominiums. So I'll turn it back to you.
Thank you. I have to say this has been such a successful partnership and we'll go through it a little bit more detail a little bit later on how CondoTek and MGIC work together. So without further ado, recently Freddie Mac guideline update came out, and was the direction of all the agencies and the country in regard to condominium lending is really has really changed over the last couple of years. Part of that was, of course, as a result of the tragic collapse of the condominium development in Surfside, Florida. But also, this is not the only reason these guidelines have changed. And I often say this, which is that these guidelines have been changing for a long time, or the industry has been changing for a long time. And when you're looking at warranting these condominium loans, looking into these properties a little bit more deeply has always been on the agenda. And we have seen this now come, I think, almost full circle, where the agencies and banks who are providing portfolio lending approvals are really looking into condominium developments to see if these properties are compliant with the structural and mechanical critical repair guidelines, to ensure that home ownership is not only available, but available in really, safe properties out there. And believe me, there are a lot of condominium developments across the country that are not very safe, that have issues with them, whether they're financial issues or structural issues or mechanical issues. In a lot of these properties, what everybody doesn't have is the ability to see the problems when they do occur. But there are some big problem developments across the United States. So this new set of guidelines that came out from Freddie Mac, I was so impressed with, because I think in the morphing, changing environment we're in right now, eligibility is incredibly important. And Freddie Mac was, I think, incredibly thoughtful in how they put these guidelines together. There is a new not eligible status for condominium developments. These guidelines echo in many ways Fannie Mae lending guidelines that came out last year, outlining the ineligibility for condominium developments, and that has now been listed or created for I think over 2,000 or 2,500 condominium associations across the United States, as well as cooperatives as well. But this new status that has now been created, it designates non-compliant condo properties as not eligible for residential mortgage financing through the agencies. These loans that have been, that are originated in these sites, essentially this ineligibility really makes it difficult for condominium associations and those purchasers or borrowers within those properties to get residential mortgage financing. But there is a really transparent process that has been created for, associations, and specifically for HOAs, where I think part of the guideline release that came out from Fannie Mae didn't have this connectivity with the HOA, where Fannie Mae is now essentially making changes to that as well. Freddie Mac came out with these guidelines and has this connected ability essentially to inform the HOA directly that their particular property is ineligible. There are new statuses in Condo Project Advisor, Loan Product Advisor, Loan Quality Advisor, and Loan Selling Advisor. It's identified, each project that is ineligible is identified in those areas of Freddie Mac's setup essentially. And there is now an appeal process that has been created for the HOA should they be on this not eligible list, or have this not eligible status, I should say. The great thing about this guideline, or these new guidelines that came out, is it's really reducing the inefficiencies that we see in originating condominium loans, processing them, closing them, spending the time to determine whether or not these projects are eligible or not. For a lot of lending institutions, is that not only a costly process in many instances, but also it's a time suck, right? To figure out, to have an originator go out to a site and write a loan in a specific development and then realize that that property is not eligible for residential mortgage financing is difficult, but there's a lot of time invested in that as well. So with this not eligible status, we're now looking at, I think, eventually, it's really going to severely cut down the repurchases that we've been seeing in the industry. All of that being said, through CondoTek's Condo Project Warrant System, we identify ineligible projects as well and provide a solution for those developments, and outlining what's ineligible about that specific property and how to fix that issue. So we have such a beneficial product in the industry that kind of combats this, but the agency itself is, with this not eligible designation, is essentially going to try and make it a little bit easier for lenders to understand what's happening within these developments. So the biggest part of these guidelines, as I outlined, is really this, appeal process that's now allowed directly by the HOA. So this is effective, by February 26th, so this month. And an HOA representative can inquire about why the development or why this particular condominium project is not eligible. And they can find out how to appeal the decision. And in many instances, fix the problem that put them on the ineligible, or provide an ineligible designation on the project. It keeps the lender, in many instances, out of the project and stops the time waste and time suck for a lender in trying to fix the problem, right? What we want to do, or what the agency wants to do, essentially, is identify eligible projects, identify ineligible projects, and really have a direct conversation with the HOA to fix the problem that exists that's making that particular project ineligible. So I applaud this. And, when I saw it come out, I was kind of dumbstruck a little bit, because it's such a fantastic thing for the industry. And it was one of the biggest complaints that we had heard about Fannie Mae's ineligibility. And they're, of course, as I outlined, in the process of correcting that as well. There is another unusual part of these guidelines, which is this required notification. So I clipped the actual guideline here, and I think it's really important to read, because from a lender's perspective, and the lenders who are on this call need to understand their responsibility to the agency, to Freddie Mac, when finding an association or condominium development that isn't eligible. So it says the seller, or if applicable, the seller's related third party with access to loan product advisor must notify Freddie Mac if it becomes aware of any information that could impact, or that is not consistent or inconsistent with the project's PAR status finding, as soon as feasible, but not later than 5 business days after becoming aware of such information. Wow. So if a lender gets a questionnaire back, or if a lender is made aware of a situation in a condominium development that would make it ineligible, they must inform Freddie Mac of that issue. And 5 days is a very short period of time in our world. So when you take on the responsibility of underwriting condominium projects, you also take on this responsibility now of notifying the agency of some sort of ineligibility. And it's really important for our lender clients to know. This is, of course, for lenders with access to the PAR system, but many of the participants today are on this webinar have access to the PAR system. So I thought it was so important to outline. Additionally, Freddie Mac has a project certified submission process. So on certain properties, Freddie Mac will allow or will provide a project certification. What's important to note is that this, project certified designation that does appear is that pathway to a quick turnaround for residential mortgage financing in that building, to closing a condo loan in that building. What a lot of we've fielded a lot of questions on this topic recently as well. And a lot of people are asking, look, if Freddie Mac has decided that this project is certified, is there anything else that the lender has to do in making a determination on whether they could sell a loan to Freddie Mac, essentially reduce their repurchase, reduce the likelihood of having a repurchase on the site. And, within the guidelines, it's pretty clear in every instance when you're reviewing a condominium loan, you must look at that project and make an additional determination about, critical repairs, if there are any critical repairs in the project, if there's any new litigation in that project, and identify at that point in time when you're underwriting that loan in that project, if anything is going to jeopardize that project certified status. So although it is a clear runway to closing a loan, if you have a project certified status, you still must do your due diligence as a lender and make the determination on critical repairs, litigation, and any other issue on that particular project that may cause that project to be ineligible for residential mortgage financing. So there's no fee to Freddie Mac essentially to get this project certification. It's a pragmatic process, and really the way we see it is eventually what we're hoping in the industry is that there are going to be so many condominium projects and condominium buildings across the country that are on this list and that are certified through the agency, that will make it a very quick process to originate and close loans in these buildings. As I outlined, Fannie Mae is making some changes to their guidelines as well, and they came out with a notification late last year to provide greater transparency for HOAs that have been added to their unavailable designation. So that's supposed to be arriving soon, where I think in mimicking Freddie Mac's guidelines in some way, in ensuring that HOAs are notified when they have received an unavailable designation. Again, with Fannie Mae, just as in the same case with Freddie Mac, you really have to focus on the critical repairs and insurance compliance, which has become such a hot button issue right now. And and by the way, on the insurance issue, we're finding that a lot of the large lenders out there are rejecting hundreds of condominium developments a month for insurance non-compliance. And it's become a major issue in the industry, especially as it relates to the deductibles that we're seeing out there. And just to explain this for a second, even though we don't really have an insurance slide here, I think it's important to outline. There is a major shift in the insurance world where we're seeing increased insurance premiums anywhere from 35% to, in some cases, 300% for insurance cost increases. And that's happened over the last 12 to 24 months. So we're seeing condominium associations being faced with these huge increases to their premiums, which of course means everybody's maintenance costs are going up in the building in order to pay for these insurance increases. And where we see a lot of associations run afoul is with their deductibles, in order to kind of reduce the increase that a carrier may provide to an association. So let's say your insurance is going from $100,000 a year to $250,000 a year. In many instances, one of the ways to reduce that incredibly high insurance cost for the association is to increase your deductible. So we're seeing deductibles that for decades were at $25,000, $30,000, $40,000, $50,000 for each deductible for every policy. We're seeing deductibles now in the range of $250,000 per instance. And that's a red flag and a major issue. And it also relates to how much your operating budget is, because there's a maximum percentage of your operating budget that can be, that your deductible can be. So we're seeing a lot of these insurance companies increase their rates, and a lot of condominium associations increase their deductibles in order to reduce the increased premiums. And that is forcing a lot of these developments into this non-compliance and onto an unavailable designation for lending in these properties. So incredibly important to understand that right now. So Greg, do you want to take a crack at the CondoTek and MGIC relationship, and how we've already outlined how we started to work together, but what we're providing into the industry?
Sure, I appreciate that. As I mentioned, one of the biggest pain points when we're out talking with our partners on the street is when it comes to condominium lending. And I'll just walk through a couple. You guys can check them off on your fingers, how many apply to you. The first is the cost to gather the information from the associations. That ranges widely across the country, where some associations may charge $25 to provide information and a questionnaire. We've seen some projects charging upwards of $1,000 to provide that information. That makes it very difficult for lenders to disclose on the loan estimate properly if that information isn't known ahead of time. And if it's not, then you have 3 days to do your change of circumstance. Additionally, who gathers the documentation within a shop, whether it's the processor, is it the loan officer, is it a combination of thereof? And they're reaching out to homeowners associations, insurance agents, realtors, all throughout the process to try to gather that information. Then they turn it into the lender and say, well, who reviews it? Is it a specific department? Is it a single individual? Is it any underwriter can review it? Then how do you train your underwriters to be up to date on the latest condominium guidelines from the agencies, especially if there are areas that aren't clear? The biggest example that I use when talking to lenders is, what is substantially complete on a new project? The guideline says that it has to be substantially complete. I could ask 10 different people and get 10 different answers. And so because of all of these issues, we partnered with CondoTek because what they do is, the minute a property is determined to be a condominium, the loan officer or anybody in the shop can utilize CondoTek services to go out and gather all of the required documentation on behalf of the lender, then review all of that with their team of condo experts, determine the warrantability of that project, and provide life of loan coverage if that warrantability of the condominium was ever challenged by either agency. In addition, we partnered with them because our condominium guideline requirements are very similar and mimic the agencies, but we have additional things such as exposure within a project. If we insure more than a third of a project already, we don't want more than that. Maybe we have them on an ineligible list for some other performance issue in the past. So at the same time a lender is having CondoTek review for agency warrantability, CondoTek is working behind the scenes with MGIC to confirm insurability with MGIC. So it makes it easier for the lender. If there are any lenders on the call today that have the ability to portfolio, an additional added benefit that the relationship provides is, when they determine warrantability, they don't just say yes or no. They provide a complete compliance report that tells you, yes, it's warrantable, or no, it may not be warrantable, and here are the reasons why. The loan officer, processor, whomever can go back to the association, realtor, et cetera, and try to get those reasons fixed to make it warrantable. Or if you're a portfolio lender, you may say, this is a loan that we want to hold. We're comfortable with this risk. The lender can work with their local MGIC representative to check and see, are we okay with this reason for non-warrantability? Are we okay insuring this? And so it's an easy one-stop solution. In addition, CondoTek charges a flat fee to provide the service, which is inclusive of any fee the association charges to provide the documentation. So you never have any documentation issue or disclosure issues or cures for an inaccurate fee. It can all be passed directly on to the borrower. That said, it will not speed up the process necessarily, but it'll take the headache away from the process and many of the pain points that lenders are faced with. And so that's why we were happy. Did I do that justice?
Yeah, I don't think I could have done a better job. That was perfection.
Well, thank you. And yeah, as we said, there's a couple more slides Orestes will run through, but we're happy to answer any other questions afterward and or down the road. Back
And
to
one
you.
thing, yeah, thank you so much for that, Greg. The one thing that's really, and just to reiterate, this last bullet point here, each warranted loan that we review through our condo project warrant review process receives a confirmation of insurability with MGIC at the point in time of determination. So it's really nice to have an automatic, process of, for a lender of not only ordering the documents, getting a review on the project, but also getting this, warrant and confirmation of insurability with MGIC. So I know you said it doesn't speed up the process, but I have a feeling that taking that time to also, ensure that mortgage insurance is available on the site may take a little bit of time, that we've, kind of ratcheted this up to a point where it may save some time for our lender clients. So that being said, there are some resources here that we thought were important for you to have. And Freddie Mac, again, has done an incredible job. There's even a tutorial that they have put out for HOAs to essentially, inquire about the ineligibility of a particular project, and of course, get a reason on how, or get a way or a solution on how to make that condominium development eligible again. That tutorial is easily found. The link is here. We also included the bulletin that came out, the press release that came out, and Freddie Mac's FAQ. Now, if you've ever been on one of my webinars before, I'm a big fan of the FAQ. Giant fan of the FAQ. There's so much information included in both Freddie Mac's FAQ as well as Fannie Mae's FAQ, and I would encourage you to go there if you can, to ask your questions or see if somebody's asked it before. In addition to that, whoops, I don't know what happened there. There it is. I clicked the link by accident. In addition to that, we also included some contact information here, as well as an outline of the products that CondoTek offers. Again, every single condo project warrant comes with a determination on MGIC mortgage insurance eligibility. So with that being said, Tony, how can do we have any questions that we may want to address? I know we only have a minute or two left. If there's anything let me pop into the Q&A. I don't think there's been.
We did have a few questions. One of them is, are associations, HOAs being proactively being advised that they are not eligible, or is notice given only after a loan has failed?
To answer the question appropriately, it remains to be seen, because supposedly what's going to start happening is HOAs are going to start to be notified once they get onto that ineligibility list, or have that ineligible designation added to their site. That could happen in a number of ways. It typically happens when a loan is originated and a loan goes through Fannie or Freddie, and essentially it's tagged as being an ineligible project. That's the most common reason for it to go on the list.
Excellent, thank you. And then can a higher deductible master insurance policy issue be cured, in quotations, by an individual HO6 on an individual loan?
Michael Borodinsky, so happy you asked this question, because it actually is a very tough question. The answer, I've asked this question before, and the answer is no. The association must have their deductible issue, or any insurance issue, cured at the HOA level. Essentially, you can't cure an issue with an individual HO6 policy on the development.
And
go ahead.
I'll just add a little bit that the thought process behind that, if you think about it from a risk perspective, is even though the individual loan you made to that consumer may have additional protections from that individual HO6 project or policy, if the project were to have go down because of an issue, or because of lack of reserves being able to pay for those increased premiums, that could affect the entire project, which could affect value in that project, which would affect all lenders. And so the agencies have been pretty clear that they want that for the association itself.
Yeah.
And then Greg, there was a clarifying question. You were talking about if something was specific to MGIC or if it's across the board for other MI companies. Can you address that or
There are other MI companies?
no?
Okay. I didn't think so. But
Sorry.
the answer is we are very fortunate to have an exclusive relationship with CondoTek, where right now we are the only MI company providing that insurability information.
Excellent. Thank you so much. And then we've got one more question. Any changes coming for ACV on roofs versus full replacement costs?
You know, there's another hot topic right now. Nothing that we've seen recently has come out about it. And I think there was even an FAQ question that was posed that hasn't been answered yet. I've heard it from a couple of different folks who have asked that question. It remains to be seen what the agencies kind of respond, how the agencies respond there. Look, there's been a lot of difficulty essentially also in making the appropriate determination. We're seeing in many instances, like I'll give you a great example right now, not as it relates to that specific question, but as it relates to roofs. We saw a site recently that had a reserve study that said the roof had less than a year remaining useful life on it, but also added a comment stating that the roof was in fantastic condition. It was in very good condition. So if you're a condominium board or an association and you have your roof over your head and you're saying, well, I don't want to spend, I think the cost on this roof was $450,000. I don't want to spend $450,000 today if I don't have to for a component that is in very good condition, even though our reserve study states that it has a remaining useful life of a year, because they've also added in a comment that it was in very good condition. So there's a lot of very unique questions that are starting to get raised when you're reviewing these specific component issues within these developments that frankly are being answered individually right now by the agencies in many ways, because in that instance the board had, or the HOA had, over $1 million sitting in their reserve account. So they could have made the repair tomorrow without a special assessment. It technically wasn't a critical repair. And our opinion on it was that it was absolutely fine to close that loan, because not only did the reserve study engineer outline that the roof was in very good condition, but the association had every single dollar they needed to repair that roof without having to get a special assessment. So very unique instances in the industry right now.
Excellent. Well, thank you so much. Thank you all for your questions. I know that we have a few that we have not addressed, and we will address those offline. Appreciate it, Greg. Appreciate it, Ors. Thank you so much for always bringing such excellent content to the Mortgage Collaborative. Thank you all so much for stopping by to the TMC Connect today, and we hope to see you in future sessions. Thank you, everyone. Have a great week.
Thanks, everyone.